Hi, in this video, we are going to have a brief discussion on margin trading. Margin trading is a term used to denote buying or selling financial assets using leverage. So leverage here means using somebody else's money. It's a form of debt. Thus, a margin trader is able to deposit a certain amount of money, usually less than the value of the assets, to purchase those assets. This amount is less than what he or she would have had to pay if they tried to buy the assets in the regular traditional way of using own pockets money. So the term margin here refers to the percentage of the amount contributed by the investor. The idea behind margin trading is that leverage can magnify the gains. On the flip side, the losses too can be very harsh. Let's try to understand this with an example. Let's say we want to buy 100 shares of Tesco plc from London Stock Exchange. Given the current price of Tesco, £236 per share, for 100 shares we would have to pay 23,600 British pounds. Now if we want to buy this the old-fashioned way, we have to pay our broker the full amount, plus some transaction costs. But for the sake of simplicity, let us assume that there are no transaction costs. That will help us keep the calculations simple. But let's say we want to take advantage of the margin facilities provided to us by our broker. So, if we have margin, we don't have to pay the full amount of 23,600. Instead, we only need to pay a portion of that. What portion? Let's say our broker allows us a 60% margin facility. That means we only have to pay the 60% of the entire amount of 23,600. So 60% out of our own pocket, the remaining 40% will be paid by the broker. So how much do we have to pay? 60% of 23,600 equals 14,160 pounds. The remaining balance of 9,440 will be paid by the broker. So together, when I buy the 100 shares, the broker will clear the trade and pay off 23,600 to the exchange, who will then give the money to the seller of the stocks. Now there are two things that can happen here. Let's take a look at a hypothetical bullish scenario where the price goes up. Now let's say after 2 months the price of Tesco shoots up to £270. What then happens to our stock holding performance? Remember, we own 100 shares, so our 100 shares are now going to be worth 100 times 270 equals £27,000. But our initial value was 23,600. So we made an additional £3,400 in profit. Okay, so let's say we decide to sell these shares and we receive 27,000. But remember, out of that 27,000, 9,440 belongs to the broker. So we have to pay that amount of money back to the broker. How much is going to be our profit in this scenario? It is going to be 3,400 divided by 14,160 because our initial investment is 14,160. So we make a profit percentage of 24%. But if we didn't use the margin facility, if we paid the entire amount out of our own pocket in the old-fashioned way, our profit percentage would have been 14 point something. Because then our stocks would appreciate by the same amount, 3,400, but the initial investment would have been 23,600. So 14.41% would have been our gain. But because we were able to finance a portion of this purchase through the broker's margin facility, we had to put up a smaller amount of upfront investment. So we make the same gain by putting up less money upfront. In other words, we are magnifying our returns in percentage terms. And this is why margin facilities are so attractive to traders. Okay, so you might want to ask a question here. Why would the broker allow this to happen? Well, that's because the broker has a kind of a safety net. The shares of Tesco that we are buying, the broker can hold that as a collateral in case I ever default in paying back the £9,400 that my broker is financing. So in other words, if for some reason the price of Tesco goes down substantially and I make a loss of an amount that is close to 9,400, the broker will have the right to sell those stocks, sell the 100 shares of Tesco to recover their money. And this is why they are able to finance this. Of course, there are some interest costs involved because, as I said, this is a kind of a debt. So for however long amount of time you will be holding this position, there is probably going to be a daily interest rate charged. So this is also not free. Again, for the sake of simplicity, we're not going to get into the interest calculations at this point. So next, what I wanted to show you is the bad scenario, where the price of the stock goes down. The idea behind showing this to you is that just as margin trading can be a very lucrative trading strategy, it can also backfire. And when it backfires, it can be really disastrous to the entire portfolio. And by that I mean you might end up owing money to the broker. So, in our second scenario, let us assume that the stock price of Tesco falls down to 200. So we still own the same 100 number of shares, but our 100 shares are now going to be worth £20,000, £200 per share. So how much money did we lose? We lost 3,600. So after selling those 100 shares, now we have 20,000 in cash. But out of that 20,000, 9,400 and something will have to be paid to the broker. How much are we left with? We are left with just a little over 10,000. But how much did we start with in the beginning? We started with 14,160. So our loss percentage is 3,600 divided by initial investment of 14,160. So that comes to almost 25.5%. But if we did not use margin facilities, if we paid for the entire position out of our own pocket in the old-fashioned way, our loss in percentage terms would have been a lot less, because then our loss percentage would have been 3,600 divided by our initial position of 23,600. So in percentage terms, that comes down to 15.25%. So with the same performance of the stock, having leverage simply magnifies your profit or your loss.